Worldly economic news, Friday, 24th of December, the year of our Lord 2010. United States savings rate going back to 1930, an economic pic data chart. Green is personal savings of the American populace. Lately, it has been going up. In red, we have corporate savings, and lately, it has been going up. The other one is yellow, government savings, and obviously they have not been going up. They are wildly minus. So we've got the two things which are going up, which are personal savings and corporate savings, and the one thing that's going down, which is government savings, non-savings. The balance out is a little blue dotted line, net savings, which goes bubbity 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 bub, and it's gone, oops, negative. Now, to put that in context, this chart goes back to 1930, chase the little dot, blue dots, all the way back, and I would think it was last negative in about 1934. What was happening then? Nothing good. Moving on, Bloomberg, China car market to extend gains over US. Automakers say auto sales in China may outstrip the United States for the third consecutive year in 2011 as world's largest car makers Toyota Motors, General Motors and Volkswagen estimate sales will grow by as much as 15% in China. Bloomberg gives us bond sales pulled as yields hit 4-month high. Russia scrapped its sale of ruble bonds for the second time this month as the prospect of rising interest rates sent yields to the highest in at least 4 months and threatened plans to double borrowing next year. Oh, so we have a little look closer at this when we go to the Moscow Times, and VAT is a likely candidate for a hike. Russia's rising budget spending, likely to be exacerbated by the 2011-12 elections, will make tax hikes unavoidable, with value-added tax likely to be raised first. Russia delayed some tax hikes during the crisis of 2008 and 9 as the government kept spending high in a bid to drag the economy out of a recession, plunging its finances into the red after a decade of budget surpluses, obviously fired up on oil, and the fact that the Russian government's only just starting to get back and put more meat on the bone. The Globe and Mail, so we're in Canada. Rein in deficits or risk EU-style crisis, Jim Flaherty warns provinces. Canada must avoid heading in the same direction as the European Union, where many countries are in the throes of a debt crisis, Finance Minister Jim Flaherty warns. He kicked off a one-day meeting with the provincial ministers in Kananaskis on Monday, calling on them to eliminate their deficits by 2015. Maybe they will, and maybe they won't. Bloomberg again, ECB lends $200 billion to banks for 3 months to meet their year-end needs. The European Central Bank will lend banks €149.5 billion for the 3 months to meet their liquidity needs for the end of the year period. The Frankfurt-based ECB said 270 banks asked for unlimited funds over 98 days, which will be loaned at its average benchmark interest rates. Not much. Banks tomorrow need to repay 96 It's not bad having Uncle central bank always there to bail you out, is it? It's not so much bailing out, it's just what they do. That's just how they operate. It's a very strange system. And over on the website, I did a post yesterday called "And We're Off" about monetary reform and the reform in the United States. Worth a look. Global Property Guide, sorry about this. Ireland's house prices plunge further as crisis deepens. No need to go into the gory details, but Bloomberg, Irish may ask court approval for Allied Irish capital injection. Ireland's government may ask Dublin court to allow an immediate capital injection into Allied Irish Bank. It's a mess. But unfortunately for the EU, it's a mess that's just festering there. And it's no point them thinking they've dealt with it. It's not that easy. And Martin Wolf in the Financial Times, who's their big boy there. The Eurozone needs more than discipline from Germany, as in finger-wagging discipline, and the opening sentence of the article is Germany rules. Martin Wolf has been following this very carefully and has some particular ideas on it, and at least he knows that big things have to be done. Just kicking the can is only going to lead to trouble. I've just pulled a couple of things out of the article. Maintaining the Eurozone is in the enlightened self-interest of Germany. And I think Germans and German politicians know this. The issue then is not whether to preserve the Eurozone, but how. Onto us, following on in the paragraph, but a slightly different point to be got at here is, it has not, as the conventional wisdom now goes, been a fiscal failure, in other words government spending, except in Greece, which is for sure. It's the private sector, stupid, he says, and it has been borrowing by the people and lending by the banks that has got grossly out of proportion. And the article finishes with this paragraph: the German government surely does intend to do what is needed to keep the Eurozone together. But the Eurozone it has in mind will be desperately uncomfortable for many members, because Germany isn't going to let them off lightly. It is going to nag them and push them and crush them. This is largely because the failings of the Eurozone have not been fiscal irresponsibility, repeat, but macroeconomic divergence, financial irresponsibility, asset price bubbles, and huge shifts in competitiveness. Beautifully summed up subjects that I could certainly go on for hours about. If the Eurozone is to work better, it must manage these disorders. The challenge is to design a system that will do this. Germany has to play the leading role. Should it fail, it may wake up to find it has lost the Eurozone in a fit of absence of mind. It's all down to Germany. Will they play their part well or badly? The entire Eurozone depends upon it. Finish with abnormal returns and their chart of the day, entitled The Most Important Macro Graph of the Year by Gavin Davis. Is he Barclays Capital? Don't know. The name rings a bell anyway. This particular chart is a similar one to the one I used a couple of months ago. This one only goes back to 1961, but it is foreign sector in spotted blue, which we can forget, and we've got the government sector in red and the private sector in green. Just have a look at it on the interwebs, and you can see it goes like this. When one goes up, the other one goes down. It is the basis for MMT type thinking, but if you don't get this sort of understanding into your head, you won't get any sort of correct monetary reform ideas into your head, I don't think. I think this has to be understood, the accounting of a sovereign country in action, which would take us round on the website. That's the last chart. Just press once more and we get back to the first chart, which was the United States savings rate, and the two charts interlink. It's a complicated picture. Economics is a complicated subject, and nobody, I believe, has any sort of huge grasp on it. It is just too big for any one mind to grasp, which is very unfortunate because it is rather important. Bye.